The first 5 years of retirement can make or break your entire financial future. A bond tent could be the safety net you didn't know you needed. Hey guys, welcome back to another episode of Your Retirement Planning Simplified. I'm your host, as always, Joe Curry. And today we're talking about how to keep your retirement portfolio resilient after and as you approach and enter retirement. This is a time when your decisions can significantly affect how long your money lasts. So today we're going to cover the retirement danger zone and why sequence of returns risk matters, how to use a bond tent strategy to protect your nest egg, why a rising equity glide path can actually reduce your risk over time, how regular tune-ups and rebalancing can keep your plan on track. So by the end of this, you'll understand how to make smarter decisions to preserve your wealth through retirement. And if anything I just said there didn't make sense, we're going to break it down further as we go. So to get started, we're going to start with the retirement danger zone and sequence of return risk. So these are things I've talked about on the show before. But basically, in your late 50s into your 60s, as you're entering what we call the retirement red zone, this is the time as you're approaching retirement and your first several years into retirement, right? So why is this? It's because this is when your portfolio is usually at its peak value, and any losses now, so right before you retire or right after you retire, they're going to have a bigger impact than losses later on in retirement or earlier on while you're still contributing and saving. Because if you're putting money in every month and you're 40 years old, when markets go down, you're buying more shares and all is good, right? So it's these critical years just before retirement, which if things blow up, that could really affect your timing of retirement. And those early years in retirement, if things really blow up, again, it's the peak value of your portfolio. It's having a bigger impact. It can affect how long your money is going to last. So this is really what we call sequence of returns risk. So, we can have a lovely projection that says, hey, you're going to get X percentage returns throughout your retirement. But we all know that markets don't give us straight line returns, right? If we want to get straight line returns, we need to buy something like GICs where we just don't get enough return to keep up with inflation and get you through your entire retirement. So we need to take on some of that sequence of return risk, but we want to be able to manage it. So you can think of this kind of like you're driving on a mountain pass and you're close to the edge. The road is winding, much like markets go up and down. And one wrong turn, so a bad market year, and you could go over the side. So that's why managing this risk right now is so important. We don't want you going over the side. Now, this leads me into why we might want to build a bond tent. So the bond tent is designed to defend against those early retirement risks. So, and especially if you've gone through and done a retirement income style assessment and understand your retirement income style, if you're someone who is more income protection or time segmentation, so maybe a little bit more conservative, really want to prioritize maintaining that equity you've built up over the years or that capital you've built up over the years, the bond tent is a strategy that might be a really good fit for you. So here's how it works. In the years leading up to retirement, so probably as early as 5 years ahead of retirement, you actually start increasing your bond allocation. So you're holding a higher percentage of bonds during those years leading up to retirement, and then in the first 5 or maybe 10 years of retirement. Eventually, though, you actually start to gradually decrease the amount you allocate towards bonds after that initial window. So if you're looking and you're picturing this kind of like a line graph, you can picture a shape of a tent. So, let's say your bonds, as you're saving for retirement before you enter the retirement danger zone or red zone, you have maybe only 20% of your portfolio is in bonds. So maybe you have a portfolio that's 80% stocks, 20% bonds. So as you approach retirement in those years leading up to retirement, the bond allocation starts going up. Eventually it peaks. You might hold it there for a few years in the first few years of retirement, and then it starts to gradually come down later into retirement. It comes back to a number that we settle on for your longer term retirement, which may be something more like the traditional 60% or 70% in equities, meaning you only have 30 or 40% in the bonds. So when we picture that increase in bonds and then coming back down, that's where we get the name the bond tent, because it basically draws out the shape of a tent. And the idea here is it's giving you a cushion during the riskiest years of your retirement. So those bonds act like a shock absorber. If markets drop right after you retire, you don't need to sell stocks at a loss. You can draw from those bonds and giving your stocks more time to recover. So we'll just talk about a hypothetical example here. Let's just take our hypothetical client, Linda, who's 63. She's just retired with a $5 million portfolio. We built her bond tent starting at 20% bonds 5 years ago. So she was in that 80-20, so 80 stocks, 20% bonds as she was saving for retirement. But 5 years ago, we started growing that allocation to bonds up to 55% as she approached retirement. So now in her first few years retired, she's using those bonds, the income coming off those bonds to fund her lifestyle and avoiding any equity or stock drawdowns when markets get volatile, right? So when markets are coming down. So soon, after a few years into retirement, we would start to plan dialing those bonds back and increasing the amount of her equity exposure. And just to be clear here, when I say equities, I could say stocks, shares, companies. I mean the same thing, right? It's ownership in companies. So the result here is that if she gets a good sequence of returns, so in other words, returns are good in the early years of her retirement, sure, she's given some of the upside away, right? But she's still in a good position and she's comfortable getting through that retirement red zone. Everything still works out okay. But if she gets a bad sequence of returns, so if early into her retirement, returns are really bad, the market crashes, she has that extra buffer that helps her avoid selling stocks at a loss and minimizes the impact of that market volatility during this crucial period. So at the end of the day, for Linda, that means some more peace of mind and a smoother ride through the retirement red zone. So let's talk about the other side of this bond tent, the rising equity glide path, right? And so now this is where it gets counterintuitive to what you might read if you're reading some just general rule of thumb retirement articles. So instead of reducing our equity exposure or reducing our stock exposure as you get older, there's some research that shows that gradually increasing equity or stock exposure in the early years of retirement. When I say early, again, we're getting through that retirement red zone. But once we get through there, increase in our equity exposure can actually reduce your long-term risk. In other words, raise the amount of money you can take out of your portfolio throughout your retirement. So let's just say we're starting retirement with a modest equity allocation of, say, only 40% now. And then increasing that gradually over, say, 5 to 10 years is going to help manage that sequence of return risk, right? So if markets start really low, your dollar cost averaging. So in other words, as we start to increase the stocks, if the markets were bad, now you're buying stocks at a lower price, right? And if markets are strong or stayed strong during those early years, again, things still worked out and you got through that retirement red zone. So there's some empirical simulations from a couple of my favorite retirement researchers, Kitsis and Fowl, and they show this approach slightly increases your safe withdrawal rate, as I mentioned, so the amount of money you can safely take out of your portfolio throughout your retirement compared to the traditional glide path, which is actually the opposite, where you're reducing your stocks over time. So think of that kind of rule of thumb, 100 minus your age is how much you should have in bonds. So that would be the more kind of traditional rule of thumb, and we're turning that upside down here when we talk about the bond tent. So I'll just try to kind of walk you through how this all plays out. And just an example, and there, we could put different timelines on this. A lot of this has to do with your situation. Do you have other guaranteed income in place? What's your health look like? Are you married? There's a lot of different things we're going to take into account in your retirement income style as we're putting this together. So this is not a one size fits all, but anyway, something to consider. So let's just say that, in year 5 years out from retirement up to retirement, we're increasing the bond allocation to form the peak of the bond tent, right? So perhaps we go from 20% in bonds to 60% in bonds over that time. Again, depending on your risk tolerance, your comfort level, your portfolio size. And let's just say from years 0 to 10 of retirement, you're spending from the bond reserve first, allowing equities to gradually increase as bonds deplete. And that would be one way to do it. Another way to do it would be to be more controlled and having targets for each year where you want your total equity and bond exposure to sit at. And we would rebalance back to that. So let's say after year 10, equity allocation has now stabilized back to a more normal retirement portfolio that we potentially could have just started with, which may look like more in the range of 60% or 70% in stocks, meaning 40 or 30% in bonds. So that bond 10 has come back down. So at this point, the bond 10 has fully been spent down, but the bond share, just to be clear here, the amount in bonds is still higher than where you started before you started building your bond 10, right? So maybe you were 100% in stocks, 0% bonds, maybe you were 80% stocks, 20% bonds. That could be pretty typical in the years, more than 5 years out from retirement. So when we get to the end of the bond tent or the equity glide path, you're still going to have a little bit more in bonds than where you started. So in short, or to summarize, not a linear slide down in equities, but a measured dip and recovery. So this is kind of the opposite of the 10. Right now we're talking about the equity side of things. So your stocks go down approaching retirement. And then once you're well into retirement, start coming back up. So instead of a tent, if we look at that line graph and we're showing your stocks, we would see more of a V or potentially a U shape as opposed to the tent. So hopefully that makes sense. If you're seeing this on video, it's a little bit easier to have the visuals. But at the end of the day, the whole idea here is we want to reduce your risk through the retirement red zone, those danger years of retirement. Now, as with any planning, we need to make sure you're having regular tune-ups and rebalancing if you're going to implement a strategy like this. So the plan is not set it and forget it. Your markets move, your spending patterns change. So that's why it's critical to continue to check in on the plan, rebalance back to your targets for the portfolio. And when I say rebalancing, I mean trimming parts of the portfolio that have grown too large and topping up the parts that have shrunk. So let's say we wanted to have a rising equity glide path, for example, and say we wanted to get you to 70% in equities by age 70, but because of markets, maybe equities grew really quickly and did really well. So by age 67, you're already at 70%. That's probably quicker than we wanted. We have a plan to keep you on the glide path. So we would rebalance back and keep you in check and eventually get to the 70% on target, right? Because again, markets don't move in a straight line. So the idea of that is it keeps your risk level and consistent. Okay. So the last thing I guess I'll say about rebalancing is that this is not something you need to do day to day or every day. You don't need to be watching the portfolio and driving yourself nuts. Some annual or semi-annual rebalancing is usually enough. Okay. So to recap what we've covered here today, number one, the retirement red zone. This is the riskiest time for your portfolio, and you want to make sure you have a plan to manage sequence of return risk. The bond 10 is one way. There's other portfolio strategies. There's also other withdrawal strategies like our guardrails, dynamic withdrawal strategies we've talked about in the past. There is also different investment products or ways to create guaranteed income, which might address this as well, right? So you just want to make sure you have a plan, though, for how are you managing that sequence of return risk. The bond 10, we talked about what it is, so shifting into more bonds as we approach retirement in the first years of retirement. And then number 3, the rising equity glide path, where we bring the bonds back down, again, increasing stocks later on in retirement, and rebalancing. So when we have the plan, making sure we're sticking to the plan, our regular check-ins, and keeping the portfolio at the risk we're targeting. So by taking these steps, you're going to give your retirement portfolio a chance to go the distance. And that's really what we're trying to do here. So I hope you guys enjoyed the show today. If so, please like and subscribe. And if you want some more retirement education, please check out retirementplanningsimplified.ca, where you're going to find all of our podcasts and YouTube videos and blogs. Thanks, guys. Until next time.